Good morning, and welcome to today's Moss Adams webcast, Navigating Property Tax Strategies in 2025. Again, I'm going to play a brief housekeeping video.
Welcome and thanks for joining us. Moss Adams webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% or 3 of the 4 polling questions, which we'll ask throughout today's presentation. Polling questions will appear within the slide window. To participate in the polls, please click on your answer and be sure to hit the Submit button to record your response. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today, we'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our group CPE attendance sheet to receive credit. The attendance sheet is available in our slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit only can be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams: Michael Clayton, Managing Director; Jacob Johnston, Senior Manager; Ted Kolman, Senior Manager; and Renee Bartlett, Senior Manager. Today, Michael will discuss 2025 Colorado reappraisal, Western States assessment appeals, and issues concerning decline in value. Jacob will share property tax assessments for oil and gas wells, Texas. Ted will address business personal property tax, Freeport exemption, Texas, and Renee will provide insight on calamity and disaster property tax relief 2025 California wildfires. And to start, we have our first polling question of the presentation. How do you think your most recent real property taxable values compare to fair market value? A, they are below fair market value. B, they are above fair market value. C, they are within an acceptable range. D, they vary by property. E, I'm not sure. I'll give everyone a few moments to respond here, and just a reminder, to participate, please click the button next to the answer you choose and hit Submit. Give everyone a couple moments here to finish your questions and answers. Awesome, and let's take a look at the results.
Great, thank you, Talia. It looks like on the question, how do you think your most recent real property taxable values compare to fair market value? It looks like C, they are within an acceptable range, is the number 1 response at 28.4%, followed by they are below fair market value. So again, thank you everyone for responding to that question, and we will have the opportunity to address some of that in today's presentation. I will start off by addressing, as Talia said, the Colorado 2025 reappraisal. As it shows in this chart, Colorado reappraises every 2 years in the odd-numbered years, and they're required, the assessors, the county assessors, who are required to establish fair market value, they're required to issue their notices of value no later than May 1st of 2025. The valuation date is June the 30th of 2024. So almost a year prior to when they end up sending out those notices of value. And that valuation date is, if you were to take a photo, boom, what is the value of your property as of that date? Now, the assessor uses information for the first half of 2024 and all of 2023, and they use that information in order to come up with what they determine to be fair market value. The taxpayer must file an appeal no later than June 8th. June 8th this year is on a Sunday, so they've extended the deadline to June 9th. If you miss the deadline, in most states, you're out of luck. They're going to say, hey, you have to wait until next year in order to file an appeal. But in Colorado, they have an abatement statute that actually reads that taxpayers have 2 years from the time taxes are levied in order to file an appeal. So if you did not file an appeal in 2023 or 2024, you have an opportunity to go back and seek refunds for prior years' taxes paid. So let's look and see what the assessors did during the last reappraisal, which was 2023. At the bottom of the graph, you see 10 counties, and they are Denver metro counties, as well as El Paso County, which is Colorado Springs to the south, and Larimer County, which is Fort Collins to the north. These counties in 2023, you can see that they increased residential, commercial, and industrial values significantly. The average for those 10 counties showed 40% increases in the residential values, 27.5% increases in the commercial values, and industrial properties saw a 35% increase. So what was the result of all that? Well, in 2023, this graph shows by reappraisal year how many assessment appeals were filed. And if you look at 1991 through 2021, it averaged about 100 to 150,000 assessment appeals per year. 2023, that more than doubled. So people saw those increases, got a little excited, and said, I don't think so, and they filed appeals. Now, the gray bar, which shows 57,000, that represents how many of those 318,000 appeals went to the County Board of Equalization, which is the second level of appeal beyond the assessor. That represents 18%. So not very many people filed to that second level, either because they were successful in getting a reduction, or in many, many instances, people don't like going to County Board of Equalization, where they have to prepare a case, present a case, and I know that many taxpayers also feel that the county board doesn't give them a fair shake and they rubber stamp their appeal denial, so they throw their arms up in the air and say, why bother? Well, again, our recommendation, as we'll discuss a little bit later, is to continue with that appeal process in order to get results in tax savings. This graph shows what's been going on with actual values in Colorado over the last 40 years. And you can see early on the difference between actual values from the assessor and residential actual values were very similar in the 1980s and 1990s. And around 2003, 2005, the spread was rather significant. Today, or in 2023, the last reappraisal year, the total actual value of residential property was $1.3 trillion and $289 million for commercial property. So residential property was 4 times the value of the commercial property. So what does this mean? Well, in 1982, Colorado had the Gallagher Amendment. What did the Gallagher Amendment say? It said, hey, you know what? Taxpayers, residential owners of property, we want to take care of you. So commercial property is responsible for 55% of the tax burden. Residential's required to take on 45% of the tax burden. So by the time we get to 2017, you can see where that graph started to spread out, that in order to meet that 45% split, the state had to drop the residential assessment ratio significantly in order to meet that 45% spread. And as you can see in the last column, the tax multiple for residential versus commercial is 4 times. Commercial is 4 times that of residential. So what does that mean? If I have a residential property in Colorado, okay, and the assessor says it's worth $10 million, you do the calculations, and I pay about $54,000 in property tax because of that 6.8% assessment ratio. Now, if I have a commercial property and the assessor says it also is worth $10 million, you do the calculations, and I end up paying $221,000, or more than 4 times that of a residential property. And keep in mind that residential property can be an apartment complex. It can be an assisted living facility. And so if I have an office building, a retail property, or a hotel, I'm going to pay significantly more because of my assessment ratio. Now, Colorado appeals procedures. We already talked about that June 9th, 2025 assessment appeal deadline. And you want to make sure you take advantage of that if you can. Well, when you file the appeal, what do? Well, yeah, you can fill out an appeal application and submit it to the assessor. But if you want to increase your chances of a successful appeal, we feel very strongly that you should submit as much evidence as you can to demonstrate why the value is excessive. You can't just say, oh, my taxes are too high. The assessor sets values and defends values and has nothing to do with the tax itself. So one of the things we suggest very strongly is, at a minimum, look at your value online. It'll tell you what the assessor says your square footage is, or how many units you have, or when the property was built, and many other property classification facts. And you'll be surprised how wrong they can be, where that data may not match up with the true facts of your property. That can be included in an appeal. Additionally, if you look at the 4th bullet, assessors are required in Colorado to consider cost, income, and market approaches to value. Cost approach really applies to new construction. Well, how did they arrive at that value? You can request property record cards from the assessor, and in doing so, you can see how they arrived at value. Income producing properties, the assessor will do an income valuation model. And in that income valuation model, they make assumptions. They do mass appraisal. So they don't know how your property is performing. And you can look and see if the vacancy rate is where it should be, whether the rents really reflect what you're getting for your property, what they're using as a cap rate, and what the expenses are. It's interesting in Colorado because in exchange for that preferential residential ratio, apartment complexes and assisted living, they're not allowed to use an income approach to value. So they have to use a sales comparison approach, as can income producing properties. You request record cards from the assessor, you can see what kind of sales comparables they used. And so often when we look at them, they have nothing to do as far as being true sales comps. So what can you do? You can put together your own sales comparables and show what those values are on a per square foot basis or a per unit basis. And with that data, you can show that based on size and age, location, or quality of the property, that your sales comparables are better than the assessor's. Bottom line, the burden of proof is on the taxpayer to show that the assessor's value is incorrect or excessive. And this data can help tell you whether you might have an opportunity to save in your property tax liability. You don't want to submit appeals if you don't know whether your value is fair or not. Whether it's a frivolous appeal or not, in Colorado, just as they have the right to lower values upon appeal, they have the right to increase values of appeal. And where we talked about assessor level, county board level, if you don't find success at those two levels, you can file to the state board. And at the state board, you generally don't end up going to the state board. You can usually reach a resolution with the assessor. And again, don't forget that you can go back 2 years. Let's talk a little bit about Western states' assessment appeals. We included just a handful of states here, and I'll handpick a few. Arizona, California, Oregon, and Nevada, they all have tax caps. Tax caps are very beneficial to taxpayers. For example, in Arizona, a limited property value can only increase 5% per year. Even if the assessor believes your property fair market value increased 10 or 15%, that is beneficial as a taxpayer. In Oregon, the maximum assessed values can only increase 3% per year, which is very beneficial to taxpayers. Nevada, they do caps according to your taxes, where they can only increase 8% for commercial property and 3% for residential property. And finally, California with Proposition 13, a transfer of ownership triggers a reassessment. And after that transfer of ownership, the property can only increase 2% per year. And in all cases, if there's new construction, renovation, or remodeling that takes place, that is outside of those caps. Texas, if you're not reviewing or appealing those properties, we strongly recommend that you do so with their annual reappraisals. Those values will be coming out next month. And again, California, most of the appeal deadlines are November the 30th. What I described as far as the appeal process in Colorado is very similar in most of these states, where you have an opportunity to meet with the assessor, and then you have an opportunity to also go to assessment appeals boards if necessary. Decline in value issues. Let me just say that post-pandemic, office buildings have experienced significant decline in values in general. What has happened? Remote workers, okay? With the remote workers, many companies said, hey, we've been able to do this successfully. We don't need all this space. Or maybe we're going to downsize. Increased vacancy, decreased rents, concessions lead to a decrease in net operating income, which certainly affects the value of the property and should be taken into consideration. We've seen many of our hotels where they've said, hey, we're in a bad part of town right now, which wasn't a bad part of town pre-pandemic, and people are concerned about their safety and crime that might be around us, and it's affected us. Multifamily and industrial warehouse, they were killing it for the last decade, and now they're seeing a leveling out and even a decrease in many situations. And of course, retail and restaurants, bankruptcies and store closings have certainly created major vacancies, which are also adding to decline in value issues. So again, what do we recommend? Hey, as you get your 2025 values, it is a time that we don't see often where assessors, in many instances, should be decreasing values. If they're not doing so, they're forcing your hand to file an appeal. And we recommend very strongly that you take a look at your values, you take a look at assessor record cards, do your homework, and provide as much information as early as you can in order to better your bottom line. My time is up, so I will pass it over to Jacob Johnston to talk about oil and gas in Texas. Thank you.
Good morning or afternoon, depending on where you're at, and thank you for joining. I'm Jacob Johnston, and for this section, we're going to dive into the intricacies of property tax assessments for oil and gas wells in Texas. This session is designed for property owners, investors, industry professionals who want to enhance their knowledge of the assessment process and its implications. All right, looks like our first polling question.
Awesome. What method is primarily used to forecast future production volumes in the valuation of oil and gas wells for property tax purposes in Texas? A, cost-benefit analysis, B, decline curve analysis, C, comparative market analysis, historical trend extrapolation, E, I own Texas wells and I still don't know the answer. And as a reminder, if you would like to receive CP credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. I'll give everyone a few moments to respond here. And again, click the button for the answer you choose and hit submit. And we will give everyone a couple more seconds here to get your answers in and recorded. Perfect. Let's take a look at the results.
All right, it looks like we've got a mixed bag here. So majority of people said comparative market analysis, followed up by historical trend extrapolation, decline curve analysis, and then cost benefit analysis. 10% of y'all said you own them and don't know the answer. Awesome. Well, thank you all for your feedback there. So let's begin with the basics here. In Texas, property taxes are assessed at the local level by the county appraisal district, and they're vital for funding important local functions, including schools, roads, and emergency services. Oil and gas wells are classified as taxable properties under this system. So it is worth noting too that most of the appraisal districts in Texas utilize third-party appraisal firms to value the oil and gas wells in their county. And the three major firms are Pritchard Nabbit, Capital Appraisal Group, and Thomas White Pickett. So valuing oil and gas properties involves a detailed methodology outlined by the Texas Property Tax Code. This code requires that the market value of an oil and gas well be determined based on the present value of future income streams, which is accomplished through a discounted cash flow valuation approach. Key factors in this valuation process include several important elements, and later in our discussion we'll explore how each of these factors impacts the overall valuation. The DCF process begins with forecasting cash flows by analyzing historical production data, current market prices, and projected trends. Assessors estimate future revenues while calculating operating expenses, including labor, maintenance, and transportation costs. An appropriate discount rate is then determined, reflecting the investment's risk. Typically, it's derived from the weighted average cost of capital or industry benchmarks. Additionally, a terminal value is estimated to account for cash flows beyond the initial forecast period. So the valuation is then obtained by summing the present values of the forecasted cash flows and the discounted terminal value. However, there's challenges such as market volatility, regulatory changes, and the availability of reliable historical data, which can complicate the process. So in summary, the discounted cash flow methodology offers a systematic approach to valuing oil and gas wells in Texas, enabling stakeholders to arrive at a fair valuation that reflects the true economic worth of these assets. Let's move on to forecasting future production. So forecasting future production is fundamental in the oil and gas industry, and it's primarily done through the decline curve analysis. This method uses historical production data to predict future outputs, employing models like exponential, hyperbolic, and harmonic declines tailored to specific operational conditions. These models aid in the planning and decision-making based on expected production trends. So this multidisciplinary approach merges geological, engineering, and economic perspectives to estimate the well's potential output and financial viability, considering the estimated reserves and extraction rate. So today we'll dive in on 3 primary factors that significantly influence the valuation of oil and gas wells. These are key areas for property owners and industry professionals to monitor closely. First is production rate, or the starting rate of production for oil and gas wells in Texas, and that significantly impacts property tax liabilities as it directly influences projected cash flows, which form the basis for assessed values. A high start rate will typically lead to substantial initial revenues and higher net cash flows, resulting in increased assessed values and consequently higher property tax obligations. And conversely, a lower start rate may generate insufficient revenues, leading to lower net cash flows and reduced assessed values, thereby decreasing tax liabilities. In Texas, the pricing of crude oil and natural gas significantly impact property tax liabilities for oil and gas wells, as the assessed values of these wells are primarily based on expected future cash flows and directly tied to commodity prices. So when the prices rise, projected revenues increase, leading to higher net cash flows and consequently higher assessed values and higher tax obligations. Conversely, declining prices result in reduced revenues, lower assessed values, and decreased tax liabilities. So this volatility complicates financial planning for operators who must navigate potential increases in tax obligations during price booms and then seek to appeal assessments during downturns. Operational expenses are another one that can directly reduce the net cash flows generated by a well. The net cash flow is calculated by subtracting the total operating expenses and taxes from the gross revenues generated by oil and gas production. Higher operational expenses lead to lower net cash flows, which in turn decrease the overall value of the well when applying the DCF methodology. So these factors are key to the valuation process, but they represent just part of the broader considerations, including technological advancements, regulatory changes, and geological characteristics. So effective management of these factors can help you navigate the complexities of property tax assessments and optimize your financial outcomes. So despite the precision of the independent appraisal firms, the mass appraisal system can sometimes lead to inaccuracies in property tax assessments for oil and gas wells. Let's discuss some of the common issues and effective protest strategies. The first big issue we see are uniformity and equity concerns. One of the major challenges we face is that mass appraisals can sometimes overlook the unique characteristics of individual properties. This oversight can lead to unfair tax burdens for some property owners. The second is outdated or inaccurate data. Another issue is that assessments often rely on historical data, which may not accurately reflect recent market shifts or challenges in operations. It is essential that we prioritize data accuracy to ensure fair assessments. The third is over-reliance on general trends. We also see a tendency to apply broad market trends in appraisals without taking into account local or specific factors. This can result in discrepancies in assessed values that don't truly represent the property's worth. And lastly, we'll have technological and methodological limitations. While we have access to advanced technologies and methodologies, they do have their limitations. And so if these tools aren't applied correctly, we'll end up having flawed assessments. So if you believe that your property's assessment doesn't accurately reflect its true value or the current market conditions, you have the right to file a protest in Texas. This process involves submitting a comprehensive protest to your local county appraisal district. And to strengthen your case, it's important to back your protest with solid evidence. And this can include identifying discrepancies in the assessed value, pointing out errors in the assessment records, and conducting a decline curve analysis to demonstrate production trends. Additionally, you will want to highlight any expense discrepancies or incorrect pricing that may have also affected the valuation. Providing comparative analysis with other similar properties can also be a powerful tool in your protest. And so by gathering and presenting this information effectively, you can significantly enhance your chances of achieving a favorable outcome. And navigating this process can be tough, so it's essential to engage with tax professionals. Our firm specializes in property tax services. It can help you build a strong protest case while working proactively with your company, the county, and the appraisal firm to improve your chances of success. And while hearings to resolve disputes are typically conducted by the Appraisal Review Board, or ARB, it's best to try and resolve these issues informally before reaching that stage, especially with oil and gas wells. Engaging in discussions with the appraisal firm or appraisal district can also lead to a more amicable resolution and potentially save you a lot of time and effort. However, if a hearing does become necessary, it's crucial to come prepared with comprehensive documentation. Having detailed and accurate records will not only support your case, but also enhance your communication during the hearing. By clearly articulating your points and referencing your documentation, you can improve your chances of a favorable outcome. So moving on, some strategies, and I'll leave you with some strategies for managing tax liabilities. Effectively managing your tax liabilities involves more than just staying informed. Strategic budgeting and planning with the help of tax professionals can significantly enhance your financial outcomes. So here are several actionable tips. First is to stay updated. Keep informed of the latest trends in the oil and gas market and understand how they might influence property values. Second is engage professionals. Regularly consult with tax professionals who specialize in oil and gas. These experts can provide strategic advice and help you navigate the complexities of tax planning and compliance. The third is work with your tax advisors to develop a robust budgeting and financial planning strategy. And lastly, maintain ongoing communication with your local appraisal district to understand their assessment methods and criteria, preparing you better for any disputes and ensuring fair assessments. And with that, that wraps up my part of the presentation, and I will be turning it over to Ted Kolman.
Thank you, Mr. Jacob. Appreciate it, man. Thank you for getting up to speed with Texas oil and gas wells. We certainly like our oil and gas here. And drill, baby, drill. That's not a political thing. That's just something to state that the more gas we can get out of the state of Texas, the better off I think we are. Speaking of Texas, let's talk about business personal property tax a little bit further along from what Jacob said, and let's talk about inventory tax and specifically the Freeport exemption. But For you CPE folks, Talia, take us away with the next polling question, please.
Awesome. Thank you, Ted. Are you taking advantage of the Texas Freeport exemption? A, yes, what a great exemption. B, no, but I need to. C, no, I don't own inventory in Texas. D, no, but we'll keep in mind for the future. E, is this almost over? We'll give everyone a few moments to respond here. And for those of you that would like a copy of today's slide deck, you can download them from the folder that says slide deck and handouts. And we'll also be sending the slides via email after the webcast.
Let's see if we have any Weisenheimers who are going to give us section E here, or answer E. We'll see.
Awesome. Let's take a look at the results here.
Thank you, Talia. Well, look at that. What a great exemption. And it is a great exemption. I get excited talking about this stuff. I don't own any inventory in Texas. Well, if you're having lunch, you can maybe eat your sandwich a little bit now, but pay attention. This is good stuff. You never know what's going to happen in the future if you do have inventory in Texas. And it's almost over. 5.7%. It is almost over. We're getting there, so just hang tight. Let's talk about this, and just kind of going off of what Jacob had said before, business personal property, not just in Texas, but in states that assess it. And there are 39 states that do assess it across the country. It's broadly defined as, think movable, tangible items, as the list showed you here. Even I like the last bullet, registered vehicles. People are like, gosh, man, don't we pay DMV fees? Yeah, in some states you also pay in property tax on your registered vehicles for a business. In Texas, we do that. But also highlighted there, inventory in some states. We're going to go over what states those are. That can really increase your tax liability quite a bit, specifically if you are a manufacturer, a distribution company, heck, even a retail stores that have expensive goods for sale. That inventory tax can be stout. Let's go with a quick little map here. So just very quickly, I know it's hard to see what the key is, so I'll discuss it here briefly. Those in the dark green are states that assess, let's call them fixed assets. So they assess a business personal property tax, but they would not include inventory, that type of thing. So that's the dark green. Those in the red, burgundy color, those are states that assess business personal property, the fixed assets, as well as inventory. There are 9 states that do that. You have Tennessee. If we have anybody in Tennessee, it is a little bit of an oddball state, and not just for property tax. No, I joke. But for property tax, you're talking about the fixed assets as well as just raw materials are assessed there. So your manufacturers are getting a little bit of extra liability added to there. And those in the light shade of green, those are states that do not assess a personal property. And just a little extra note there, if we had been doing this webcast about 18 months ago, Wisconsin would have been a dark green state. They had a statute that passed in 2023 that exempted all personal property starting last year in 2024. So now they're a light green state. So there you have it. And no, by the way, I wish that Hawaii did. I'd love to do maybe an audit or two out in Hawaii, but they do not assess business personal property. So we talked about the 9 states that do assess it. Of those 9 states, 7 offer something that would be called a Freeport exemption or something that's similar to that. Here's the list. I won't read it. You can read it yourself. But these states, again, do offer a Freeport exemption, which will help mitigate some of the inventory tax from your tax liability if you meet certain thresholds and things like that we're going to talk about. We're at least going to talk about it from a Texas perspective. So let's talk about Texas, the great state of Texas. Freeport exemption, the definition is, we talked about personal property is all components or all the business assets, including all components of business inventory, raw materials, work in progress, finished goods, the whole 9 yards. And that's as of the assessment date of January 1st. In some taxing jurisdictions, so the Freeport exemption is not a statewide exemption, it is a local option. You can mitigate your property taxes if you ship out of the state of Texas and your inventory turns at least 2.1 times, or as it's highlighted here, within 175 days. Now think aggregate on your inventory turn. So you've got you've got $10 million worth of inventory as of the assessment date, and you ship $50 million the prior year before. That's going to be considered that your inventory turns over 5 times. They're not looking down at the individual SKU level, if they will. They're looking at the aggregate number for your inventory. One thing also regarding the Freeport exemption, you do have to file an annual exemption application. It's due by April 30th, as it states at the bottom here. So it's not one of these that you file once and walk away and gosh, I have Freeport from then on. The reason why you're filing on an annual basis, as we'll see here, your data from year to year is going to change the amount of inventory, your amount of shipments out of the state of Texas, so on. So let's do a quick example. And this is a live, true example. We've redacted this as a current Moss Adams client. We do a few services for them. But we've redacted all their information to keep the confidentiality proper here. But they are an online retailer. They started as baby and toddler clothes and have now started to get into some adult apparel as well. They're based in Washington State. Most of their, a large majority of their goods are produced overseas. So most of it in Southeast Asia and China that it's produced. And then it's shipped to the U.S. and they have a McKinney, Texas distribution center. Now, for those in Fort Worth or in Dallas-Fort Worth or in Texas, McKinney is a northern suburb of Dallas. It's in Kolman County, Texas. From these online orders, they do ship globally just from this center. So it's just the one location where they have their inventory located and warehoused. And by the way, this example is going to be based on what we did a year ago for 2024. So the data you're going to see is as of the calendar year 2023. We haven't done this year's Freeport exemption just yet because, as you know, it's not due till April 30th. But looking at this data for the calendar year 2023, they had approximately 93% of their shipments went out of the state of Texas from this McKinney, Texas distribution facility. And because of that, being that they are they're again based in Washington State, which does not assess inventory up there, they were we had heard from them because they were concerned about the rising property taxes as their inventory was continued to be increased. Those of us in Texas know we're very proud we don't have a state income tax. However, we have very stout and high property tax rates, as those you know who pay any property tax bills here. So the taxpayer was very concerned about this rising amount. And what we've got here on the right side of your screen, this is an actual screenshot from the Collin County Appraisal District website. So when you're thinking of this from a Freeport perspective, you're like, gosh, this sounds great. Would love to do it. The first thing you need to do, let's go back to the point that I said, it's not a statewide exemption. You got to figure out if you're, what the taxing jurisdictions your facility is located in offer the Freeport exemption. So you can easily look it up online normally. And this year, this is the actual location for this distribution center for this taxpayer. And if you look at the bottom quarter of the screen there's 4 lines there. Those are the taxing jurisdictions. McKinney City, Collin County, Collin College is a community college district, and the McKinney ISD is the school district. So those are the 4 taxing jurisdictions, property taxing jurisdictions for this location. Okay, you're going to need that to know, gosh, man, are those, is that where they've got, Freeport? And well, luckily Collin County has a very nifty little form that they have on their website that shows exactly what entities are offering the Freeport exemption. And those 4 happen to be highlighted: Collin College, Collin County, McKinney City, McKinney ISD. So for this particular location, This taxpayer is 4 for 4. They're getting, all 4 of the taxing jurisdictions are offering the Freeport exemption, which is good news for them. So let's get down to the kind of the numbers and run some math here, if you will. For this particular taxpayer, they had about $3.7 million worth of inventory as of the 1/1/24 or 12/31/23 valuation assessment date. So about 3.7 million. Again, as we talked about, they shipped about 93% out of the state of Texas based on their shipment records and that type of thing. Technically, it's 92.7, but for this, we'll say 93%. Then we have the 4 jurisdictions listed. All 4 of them offer the Freeport exemption. So running the math there, for just this inventory, if they had not filed a Freeport exemption, or let's put it this way, if they file a Freeport exemption that doesn't get approved, they're going to pay just on that inventory about $66,000 worth of business personal property tax. Being that all 4 jurisdictions offer it, and at 93%, that number goes down to $4,800. So a savings of over $61,000 in taxes. So from a $66,000 down to $4,800. Now, we did file this exemption application last year. It did get approved. They did receive this tax savings benefit. And just so you don't think I'm pulling the wool over your eyes, that's the actual assessment notice from Kolman, the Kolman Central Appraisal District, showing what's highlighted in the yellow circle at the bottom is the exemption amount of a little over $3.4 million. That's the Freeport exemption. That's the amount of inventory that was exempted based on what they shipped out of the state. Because the Freeport exemption, the intent is that you don't get dinged or taxed on inventory that's not, that's not gaining situs, if you will. And I know some of my salt brethren are going to probably beat me up on that, but that does, go to show that they're not going to penalize you if you are shipping out of the state of Texas. So with that, I know everybody's very excited about the Texas Freeport exemption. It is something that you need to, just to recap very quickly, if you ship out of the state of Texas, you need to find out if you're in a place that offers Freeport exemption. Make sure you file by April 30th. You'll deal with the appraisal district to get it approved and granted. When that's done, you have a very robust exemption. So with that said, we're going to go from Texas to California and my colleague Renee Bartlett to talk about those awful wildfires that happened. Renee, all yours.
Thanks, Ted. I think it's time for the next polling question.
Awesome. Thanks, Renee. After the date of the damage of destruction, how long do you have to file the calamity and disaster claim form with the local assessor? A, 6 months, B, 9 months, C, 12 months, D, 18 months, and E, 24 months. Give everyone a couple moments to respond to the question. Looks like the answers are coming in slower now, so let's take a look at the results.
Thanks, Talia. So how long do you have to file that calamity and disaster claim form after the date of the destruction or damage? The answer is C, 12 months. And I'm proud of all of you. Seems like you get it. So let's move on. So what actually happened? So on the evening of January 7th, fires erupted in the Pacific Palisades / Malibu and the Altadena regions of Los Angeles County. These fires were caused by just intense hurricane force winds, coupled with, of course, how dry it is here in California, where we're always in drought, and the embers that traveled several miles around these areas and sparked other fires. So we had evacuations, we had power outages, We had curfews. I live in one of those cities that had, it was a citywide curfew. And those were mandatory in these regions, as well as neighboring regions around those two large fires. So these fires continued for several weeks. I'm sure you've all read about them. They're horrible. Excuse me. The causes of these fires is still under investigation. Of course, there's a lot of finger pointing at a power company and perhaps even some arson associated with a Pacific Palisades fire. So these fires burned over 41,000 acres and destroyed more than 13,000 structures. And that's not just homes. That could be homes and businesses, mobile homes, whatever. So what happened next? So on January 6th, the governor issued Executive Order N-1025, proclaiming a state of emergency covering Los Angeles and Ventura counties. You should know there were also fires in Ventura County. They weren't, listen, every fire is bad. Those fires in Ventura weren't quite as significant as the ones that we had for Palisades and the Eaton fire. So what this did was it extended the property tax deadlines, giving taxpayers in certain zip codes until April 10th of 2026, next year, to make property tax payments and or file their annual business personal property statements. And you see on the screen, those are the zip codes that were covered in the executive order by the governor. So Revenue and Taxation Code Section 170 covers misfortune and calamity. You'll also hear me call it calamity and disaster. It's the same thing. So the damage has to be a result of a disaster. And there can be disasters where the governor doesn't proclaim a state of emergency and you can still file a claim form. The total value of the damage has to be at least $10,000 in current market value. And this is damage to land, improvements, structures, business personal property, mobile homes, boats, airplanes, etc. So as we talked about in the polling question, the application has to be filed within 12 months from the date of the damage or the destruction occurred. So filing this claim form does two things. It puts the assessor on notice that he needs to revalue the property as of the date of destruction or damage, and it allows the tax collector to defer the current year's payment of the property taxes, right, without incurring penalties. It also prevents the need to file a separate penalty cancellation request with the tax collector treasurer's office. The M&C claim form can be submitted online or downloaded from the assessor's website and mailed to the assessor's office. So this is a copy. I know it's very hard to read, but the reason I show this is to show you it's just a one-page form. You are encouraged to submit additional documentation if you've got it, like photographs before and after, or excuse me, insurance papers, etc. But I just wanted to show you how simple the form is. So what happens after the assessor's office processes and approves the claim form? So if the reduction is granted, that value remains in effect until the property is fully repaired, restored, or reconstructed. And what's important here is that the new replacement improvement is within 120% of the property's pre-damaged value, not size, not square footage, okay? So the problem here also is that people are thinking that, you know, hey, I can rebuild, I have an opportunity to build beyond what would be considered by the assessor to be a substantial equivalent of the original property. And if you do that, you run the risk of the assessor reappraising the property to the old base year value, but then adding the value for any new square footage on top of that value. So, and as it's stated here on the screen, you know, the age of a lot of the homes in these affected areas, coupled with rising property values and delays and rising costs in construction, you know, it's probably going to be difficult to keep your pre-damage tax base under that standard, which is 120% of the pre-damaged value. So once the claim form has been approved, the auditor can recalculate the taxes and send out corrected tax bills, right? And that's pretty simple. And then to submit your claim form, like I already discussed, you can submit it online. You can actually download it and mail or do it online. You can check the status of your claim form online, which is great. Before, you really were forced to just call the assessor's office and hope that somebody answered the phone and could help you. Now, as you see on my screen, they have a dedicated email address for you to use to check online, ask questions, etc. And the last thing I want to mention is the Los Angeles County Assessor's Office has been extremely proactive in addressing this huge disaster. It has affected, as you can imagine, thousands and thousands and thousands of people in Los Angeles County who are now homeless. You know, your house burned down or your business burned down or your mobile home. And so you're suffering tremendously. And, you know, having to deal with an assessor's office typically, as my colleagues can attest to, is not always easy. The LA County Assessor's Office has made this very easy. I showed you they have a dedicated email address, and they've been doing town halls, so to speak, and Zoom calls. And so this Saturday, they are going to have a disaster relief resource fair in Duarte, which is in the San Gabriel Valley. And they will have assessors representatives on site who can answer questions and help you with anything. You can also submit documents when you're there. And the only thing you really need to do is register online with the assessor's office. It's free. assessor.lacounty.gov/events. And of course, this will be available in the slide deck. So with that, I will turn it back to Talia. Thank you very much.
Awesome. Thank you, Michael, Jacob, Ted, and Renee for a great presentation today. If we didn't have time to answer your questions, we will do our best to follow up with you after the webcast. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will be emailed within 3 weeks should you have any difficulty downloading it now. Here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Please also visit mossadams.com for future webcasts and other resources to help elevate our performance upward. Thank you for joining us, and we hope you'll join us again next time.